essentially we are talking about something that Niraj was talking about during the trade setup, which is the power space, and specifically we're going to be focusing on the power finance companies or the infrastructure finance companies. You've seen these stocks, the likes of Power, REC, PFC, as well as the newly listed IREDA run up very substantially. The question is the good news in the price? And perhaps Niraj will have a bit of an answer for you there. And there's also a conversation around the latest update from CMIE. They're talking about the Capex cycle, and they're talking about a significant update there. Of course, leading from the third quarter, the numbers look good, but the question still remains on the execution of the projects that have been announced. We've got Samina, who's got some very critical numbers to talk about there.
Should we start with her? Because that's the big macro thing.
Yeah, that is the big macro
thing. In the deep end. Okay, so very quickly, yes, like you said, the CMI data is a little bit of a mixed bag. So it's in revival mode, and that's what they're calling it. So some green shoots as we go into a brand new year. Investment mood, and I'm going to quote unquote, has improved in the December quarter. 2.1 lakh crores of new projects have been announced. Now this is 15% higher than what we saw in the last quarter. So we're all getting excited about that number. Capital expenditure, though, on the other hand, is actually much lower. So it's coming at 9.5 lakh crores, which is YOY. More importantly, that number does not look as good as, of course, the uptick in investment cycle. But I think what the street would want to take heart from is the private companies have led the way this time. So you had JSW Neo Energy has pumped about 15,000 odd crores in their project in Almora. You've also had Welspun New Energy that is pumping about 13.8 odd crores in Odisha. So both of those majors have led the way in terms of private investments. New investments are clearly coming in from the private sector on expectation of consistency, on terms of continuity rather, in terms of policy. So after what we saw in state election outcome, I think India Inc. is a little more confident in terms of making those announcements, making those investments. But the flip of that is public sector investments are still not going to pick up, right? Because there is fiscal consolidation, that's the focus. I then think the center will want to focus on that. On back of that, public sector appetite is expected to shrink, and that's the general reading in terms of what those numbers really mean. Manufacturing continues to lead the way, so 65% of the new projects have come in from the manufacturing sector, which is up nearly 95% quarter on quarter. Construction and real estate, and we've been talking about that, Niraj has been talking about how construction and real estate is suddenly seeing a pickup. That space has seen a 59% jump Q on Q, but it's up 5x year on year. So it's seen a massive jump from exactly a year ago. Electricity services continue to fall. Inorganic chemicals, so specialty chemicals, is seeing a pretty smart pickup in inorganic spending, right? So 1/3 of manufacturing is actually come from a space that, again, we've been talking about, and how we do anticipate the next 2 quarters to be the end of the rough run for the specialty chemical space. Remember, these were the darlings of the street, right? So no surprises that the money's...
question is who's going to stick their neck out and say that the bottom has been hit.
I think, guys like Hiren Ved have actually said that. They're pretty, I mean, they've had it rough. Yeah, they've or the darlings of the street, and they've gone from pride to glory to, Well, apart from that, domestic consumption will remain soft. Global demand could be a concern, so that's what you want to keep in mind. But I think what, again, we've talked about in various ways is execution. Right, that continues to still remain a challenge. So while projects have seen an uptake, only 1.2 lakh crore orders have been completed versus a 1.7 lakh crore, which is a rather average in that space. So completion has declined 15% quarter on quarter. This comes in after a 7% decline that we'd already seen in the previous quarter. So while investment outlook, capital expenditure, all of those look great, execution continues to remain a challenge.
And in fact, I think that is a theme for quite a few of the projects that have been announced in the infrastructure space as well, Niraj, where the big ticket items have come in, but then a lot of people are saying, hey, you know what, order books look great. When are you going to convert that? And I think to a certain extent, it's interesting, the dichotomy, right? So private players are now stepping up and saying, we're going to spend money, and the government spending just before the elections, of course, is going to ease off a little bit. And that is the point, right?
Yeah, and Samina was making that point as well, that, at least off air, that the expectation was that government capex at some point of time in quarter 3, quarter 4 might come off. Does private come and stand up? And hitherto we had seen private capex, green hydrogen, data storage, etc., and data centers, etc. Now, as Samina is saying, it's interesting to see that chemicals is making that large capex presence felt, and that's great news, right? Because we need this to come for India manufacturing and the capex story to stay alive and kicking.
And for the manufacturing space to really kick on into the next leg of growth, you need infrastructure, right? And from that perspective, it's an interesting segue to say that the roadmap for growth for a lot of these infrastructure companies, and indeed the financiers of those infrastructure companies, is quite strong. But the question is, and you were talking about this in your trade setup, Niraj, is that brokerages have gone forward into FY26. Are we also discounting earnings that far for some of these companies?
If you can't justify it in the near term, you just keep extending the time.
Push the goalpost a little bit.
Roll over. Yeah, I mean, so yeah, maybe too early for FY26, but Manish Sonthalia on the opening day or the opening week mentioned that that's par for the course, and he's buy side, not the sell side. So maybe you take it. But yeah, the point is, so we a bunch of infrastructure finance companies, but we are focusing mainly on power for this piece at least, and the power financiers, which is PFC, REC, IREDA, right? Now, the big picture, the power sector is expected to add nearly 212 gigawatts of total capacity during FY22 to 27. This is as per a Care Edge note that I've borrowed it from. So the existing capacity, just for reference, is 426 as of November 2023. Wow. So therefore, they nearly add 50% over the next 5 years of the existing capacity over all these years.
Right.
That's the substance of the kind of addition that we're talking about. And obviously, this happens. I mean, as any infrastructure project, debt financing is a large part, 70%, 80%, what have you. So debt financing is pegged at around 11 lakh crores for this period. Now, you can divvy up as to when does execution happen and how does the financing happen in which year. Now, that is, searching for decimals, but the larger picture is this. Now, is there advantage PFC, REC, IREDA? And there are numbers out here to take account of. So the disbursements by the IFCs, by IFCs I mean infrastructure finance companies, the disbursements by IFCs will be higher in FY24, obviously goes without saying. The various estimates range between 35 to 45% growth in disbursements in FY24 YOY. Now keep this in mind that the loan portfolio for IFCs, Alex and Samina, has grown at a CAGR of 9%, just 9% in the preceding 3 years. And banks have stayed flat.
Right.
So one, that these companies have grown their loan portfolio, but it's only grown at 9%, and that has shown this traction in earnings. What happens when this loan portfolios expand even more and earnings expand even more, ROAs expand even more? I think that's the key thing. So that is part one. The positive triggers, we know that the sectoral tailwinds would prop up the overall loans. For example, LRR Securities says for REC, the overall loans will grow by 1.5 times by FY26. Not 5, 10, 15%, 1.5 times FY26. So that is part one. 16% CAGR growth, loan growth forecast from FY23 to 26 by various analysts, and gross NPAs have declined. 2019, the peak gross NPAs were about 11% or thereabouts. They've come down, or 7% in FY19. They've come down from 7% by nearly 400 basis points. Right. So naturally, profitability also goes up as a result of that. And that's happening on account of various reforms that have been taken, right? We know about them. So that is one. The only question is, as is the question being asked for almost all sectors, is all of this is whether it's in the price or right. No, right? So REC is up 155% in the last 6 months. PFC up 124% in the last 6 months. So there's a substantial gain that has already happened. The price to adjusted book, I think this for REC, is over 1.5x FY25, not even FY24. And this is at the higher end of the valuation range. By any stretch of imagination, these stocks haven't traded at these valuations in the last decade. Now, you could argue that the decade is different from the last decade, but still at some point of time, you will think that, are we paying too much for this? And there are risks, right? Because there is a sectoral concentration. Never mind how strong the sector is. There is a client and a sector concentration out there for these companies because they're lending predominantly to one sector, not various forms of infra. Now, they're adding other forms of infra, but it's not a very large portion. So the only question, and there are no questions about growth for these businesses. The only question is the valuation.
So, okay. The other question is, we're assuming that a large chunk, and we're talking about 2 lakh crore per annum of incremental debt that is going to be required to be financed. The question is, do these entities take the bulk of it, which has been the case in the recent past because banks have been wary of getting into the infrastructure space and particularly power because they burnt their fingers in the past. And from that perspective, can the loan book grow that fast? Can it? Do they have the capacity and the appetite to grow that much?
Yeah, so banks, the share of power sector loans and infra loans has stayed stagnant, but the overall loan book has grown for banks as well. So in some sense, banks' loan portfolio has also gone up. Just that because the sector is doing so well, on hindsight, people will say that banks did not take advantage of the reformed power sector and the kind of loan book that they could have, which is what PFC, REC and IREDA have done. So now that's a question that banks will say, let's talk about it 2 years down the line when the NPAs start cropping up, if they do. Who knows?
Okay, all right. So maybe to a certain extent, unanswered question on the one, whether or not we're paying too much. Maybe we can ask a few of our experts over the course of the day to give their view. People have said that PSUs are just a tad bit hot at this juncture. Let's get their view on PFC, REC as well. But that's all we have on this edition of the Editor's Cut. There's lots more lined up before the start of trade, and do stay tuned for that. This is NDTV Profit.